Good day, and welcome back to another episode of Financial Behavior. Today, we will tackle the 2025 outlook for the markets, as well as taking a look at what retirees can do, and especially those also nearing retirement to protect their portfolios going into 2025. Okay, so our setup for 2025, we're looking at slowing growth, not a recession, unemployment inching a little bit higher. Inflation is moderated, but it's still elevated. And there should be some price pressures potentially to slow rate cuts. So, what we mean by that is, as far as the slowing growth and not a recession, consumer spending is probably going to moderate. We have tapped out most of the savings accounts, and inflation, of course, is putting a lot of pressure on people. So, the ability for the consumer to continue to prop up the economy is going to be a little difficult. We're also going to see less job switching, fewer hours, lower demand due to advances in AI. So unemployment may inch a little bit higher there. Again, inflation is still elevated. We never got to the 2% that we wanted, and that's putting some pressure on certain populations. So the feds are in a little bit of a tricky space into how they're going to do their cuts this year. And for now, they are down to forecasting only one cut versus the four that we were looking at last year. So equity markets for 2025. So we've been in a bull market for the last 3 years and without a recession. So history indicates that we're likely to reach year four. We have strong earnings growth and stable interest rates are expected. Value is a little bit elevated. Stocks are high right now, so costs are high. So we probably won't see a lot of appreciation. If anything, we may see a reset. So buy on the reset, buy on the recalibration. What are some triggers, though, that will help stocks perform? Lower interest rates, productivity gains, and some market-friendly policy changes will all be things we'll be paying attention to that could help elevate the valuations of these stocks. As far as the bond markets go, we're looking at much less volatility, so a calmer bond market than we had in 2024. Expect higher for longer in terms of interest rates. So we're thinking the Fed's going to have to keep those rates pretty high for some time to tame inflation. So attractive yields are likely to remain. We're looking at staying in intermediate maturity, so that 3 to 7 year bond maturity, and mixing in some short-term bonds as well. And we're focusing on income generation this year. So not appreciation from those bond markets, but income generation. So the overall environment is a good path to a good year for stocks. So favorable for equities. We are also forecasting continued economic growth, moderating inflation. That will support corporate profits. We do have some challenges there. Tariffs and tax cut enthusiasm. If tax cut enthusiasm goes away, tariffs are here. And that's going to challenge corporate profits, obviously. So we're also looking at as far as key risk, we're looking at acceleration of inflation again. Pay attention to interest rate volatility. That could slow us down a little bit, and geopolitical threats. So our base case is slowing economic growth with modest stock market gains, range-bound interest rates, so interest rates staying in that corridor that we're looking for, and concentrate on an income generation and a higher for longer environment. So now let's take a look at some ways we can protect those portfolios in 2025. So first thing we are advocating is basically intelligent risk management. We're going to have to get away from those passive portfolios. They do not have any risk wrappers on them. We'll talk about that in a little more detail shortly. But we got to manage risk. So here are some odds to pay attention to. Odds of a major stock market crash over any 10-year stretch is 33%. So that means the chance of losing real dollar value in your portfolio over 30 years is over 12%. Retirees can't hack that. Just think if they have those sort of losses. Ooh. Slow the fuck down, man. Hmm. So now let's turn to our retirees and those nearing retirement and how we plan to protect those portfolios in 2025. So first thing we're looking at is intelligent risk management. What do we mean by that? Investing in funds that aren't correlated, and also you're going to need some funds that have some hedging strategies. So they're either doing some options or some shorting trading, but they have some sort of hedge risk wrapper around them to help deal with the volatility we're expecting in 2025. The odds of a major stock market crash over any 10-year stretch is 33%. So that means the chance of losing real dollar value in your portfolio over 30 is 12%. So that's a huge impact when you look at someone who is investing over a 30-year period. You really got to pay attention to risk, and that's why we're again shying away from solely using passive strategies in our portfolios. As we just mentioned, you got to make hedges against large equity losses. So again, the one thing, as Warren Buffett says, that will kill any portfolio is a large loss. So just think about if we lose 10% in a portfolio, we've got to get 20 to get back to zero. So that's those type of losses are difficult to overcome. So again, we need those funds and the fund management that have hedging components to reduce this downside risk. So keep in mind that a fund's performance during market downturns is just as important, if not more important, than how you perform in bull markets. Again, manage that downside risk. Next, we got to pay attention to longer retirement horizons. So people are living, 20, 30 years in retirement easy. So we need large nest eggs or either higher returns. That means you can't just sit, as we get to in the next one, with no risk. With no risk, you've got to take a little bit of risk because you're not going to be able to sit in a capital preservation type of model, earning 3%, barely beating inflation, and expect that portfolio to last long enough to fund that in retirement. So again, we're paying attention to converting from active to passive investing. From passive investing to active investing. Again, the key thing with that passive investing is there's no risk management. Let's talk about a S&P 500 index and how that's put together. And that'll give you something to digest about why passive investing really doesn't work. So if you can imagine someone comes to you and gives you a recipe and gives you the ingredients. And they say, hey, I want you to make this recipe. Here are the ingredients. So if you can imagine on July 1st of 20, or we'll say January 1st. So on January 1st, some mutual fund company or ETF fund puts together their S&P 500 index, and everything that's in the index on January 1 goes in S&P 500. Now, what's happening throughout the year, though? Companies are moving in and out of that S&P 500 index, but that money manager is not making the change to that index. So first, you don't really have the S&P 500. You've got the S&P 500 from January 1. So the analogy is that person who just gave you some ingredients to make a recipe, they say, follow the ingredients, make the recipe, and we don't care how it tastes. That is basically what passive investing is. It's a recipe, but it's not adjusting to current times. So that's the problem with that passive investing. And we've seen it time and time again in our portfolios we've put together, that passive model just can't compete with our sector rotation strategy that we generally implement. So bringing it all together, you got to balance that growth with, key diversification, key risk management, diversification, hedging, active management. Invest in funds that reduce your exposure to large risk while pursuing healthy returns. We also want to position those retirement portfolios for safe long-term growth and income. We're in this year, we're thinking higher for longer, so we're focusing on income generation. And finally, those active risk management investing techniques are going to diversify that portfolio and avoid those large market losses for you. So as we move into 2025, that's our market outlook, what we're looking for. We'll be keeping you updated there. And then these are some ways that at least we are actively managing our clients' monies to protect them from the volatility we're expecting. We've got a couple other things we've overlaid with some option strategies as well to help those retirees that we're actively doing to reduce and mitigate that risk. So that's it for now. Till next time, financial behavior. Talk to you later. Thank you.